If you want to trade like a rebel, you got to come to RebelCon 2022. It's going to be in Dallas, Texas, at the fabulous Four Seasons Resort. It will be more fun and more live trading than we've ever done before. That's why it's called RebelCon 2022. We're going to have barbecues and double the amount of live trading. The guest speakers, as soon as we announce those, this thing's going to be sold out, limited to 250 people. Sign up now for RebelCon 2022 at the Four Seasons in Dallas, Texas.
Welcome to the Rebellion.
Happy Thursday, everyone. Welcome back to all of our market rebels. Well, more volatility in the market this week. Got a nice little bump from a Fed announcement yesterday, as expected, increase of 75 basis points. Today got a little bit dicey. Just before the open, we had GDP that was released, expected to be plus 0.5%, came in at minus 0.9, which puts us into our second consecutive quarter for declining GDP, which by some counts is an official definition of a recession. However, some economists are saying, because the labor market is so strong. Saw a little hint of that with the jobless claims that came in minus 5,000. So they were 5,000 down to about 256. But they revised the previous weeks up to 261,000, which was the highest since mid-November. So once again, just points to more uncertainty in the markets and more volatility, and that's what we're here to do on Trading Tune-Up to help you, give you some ideas to trade these volatile markets. And so if you were with us last week, really the last couple of weeks, we've been talking about vertical spreads in various aspects, and today I want to give you a different insight into vertical spreads, and we're going to talk about selling verticals against shares of stock. So many of you do covered calls, have heard about selling calls against stock, but did you ever think to sell verticals? Well, a lot of people haven't, and it can be a wonderful tool when you get into volatile markets. So let's go have a look. So I want to start off with another related strategy, and it's related in the sense that it gives us the same risk profile. It's sometimes called a combo or a semi-future. And this is where you're going to buy an out-of-the-money call and then usually sell an out-of-the-money put. And will usually be done for a credit. So let's say the stock is maybe at 97 and we buy a 100 call, $100 strike, and we sell the 95 put. So the stock is in between there somewhere. And the idea is that we're trying to take advantage of the skew. We know that the out-of-the-money calls usually get boosted, as do the out-of-the-money puts. However, the out-of-the-money puts usually get boosted more. And so in the presence of what we might call a normal skew, you're selling a much higher implied volatility on that put and kind of using that to pay for that out-of-the-money call. And if you do that, this is the risk graph you get. We get this flattened portion between the strikes, and I'll show you why that happens in a little bit. But one way to look at it is that this is your call option, right there, a little hockey stick graph, and then there is the put option. So when we combine them, this is what we get. So in a way, it's like a long stock position. We've got our plus 100 deltas up here, plus 100 deltas down here, but we just have this little flat part right in between the strikes. Now, a lot of times that's going to get boosted up above zero if it's done for a credit, but it gives you a nice little mathematical edge. But the thing is, a lot of traders like to do this, but they're always thinking, well, I have to buy a call and sell a put. Well, let's look at it synthetically. Is there a way we can get this same risk graph synthetically? And that's where it comes in to selling spreads. So let's do a quick recap of a covered call. Let's say that you buy 100 shares and maybe sell a 105 call for $5. Doesn't have to be out of the money, but a lot of traders do. So we'll use that for our example. In this case, the maximum gain is 10. We're going to pick up 5 points of potential capital gains if the stock goes to 105. And then we also get the $5 from the sale of the call. So our break even would be $95. We can afford to have that stock fall $5. That's the premium right here, giving us a nice little safety net. So we could afford to have that stock fall 5% down to 95 and just break even. So this would be our risk graph. There's our cost at 100. And if we do the if we do the 105 call here for 5, this would be our risk graph. So notice we get a bend right there at 105. There's our maximum gain. Top of this red line lines up right there at plus 10. Now we also get a shift downward in our break even. This red line is crossing here at 0 at 95. So this is the main reason for doing a covered call. We get a little bit of a downside hedge, and yeah, we have to give up some of the upside. All right, so this is kind of the negative. The two parts in green are some positives. We get a little downside hedge, and we still get some nice potential gains. But we do have to give up all of the, or at least above the strike. So you have to say during periods of volatility, especially like right now into earnings season, and we started dip before the Fed announcement, and then we rally. Who's to say what's going to happen? And so sometimes traders want to reach for that high premium. They sell that call, and then they're just terribly disappointed because the stock rallies. And of course, if you didn't sell the call, then that's when it's going to sink, and you're going to wish you had the hedge. Well, maybe we could work in the middle. Maybe we could work between these extremes. And that's where selling a vertical spread can come in. Can be a wonderful tool. So instead of selling the call, what would happen if we sold a vertical spread? Well, let's go see. One of the things I like to teach traders is to learn how to visualize these risk graphs. I get asked a lot of times by traders, I got to put it in my broker's platform and try to figure out what's going on. Well, if you learn to visualize it, watch this. Here's our long shares of stock in black. Here is the sale of the 100-105 vertical spread. So notice we have different zones. This flat portion right here to the left is 0 deltas. It's flat. Portion out here is 0. But our stock is always plus 100. So we can tell that to the far right side of the graph forever, we're going to have 100 deltas compared to 0. So I know I've got unlimited gains out here. But now take a look at this center portion. I have negative deltas here in red. I got matched with positive deltas here. That's going to flatten out. And then to the left, I'm going to have plus 100 matched with 0. I'll have plus 100. So if you look at that, you should be able to tell, at least with a little training, that this is going to give us our combo. So let's say that we buy 100 shares, we sell the 105 call. This was our covered call, but now we're going to add a twist. We're going to buy maybe the 110. And it doesn't have to be these strikes. We could do the 100, 105, the 100, 110. Choice is completely up to you. But let's just do these strikes. And let's say we get a net credit of 3. So notice that we've received a little less money. We received $3 instead of 5. If I had just sold the call, I would have received 5, but because I've bought another call, I get $3. Well, still not the worst thing. It's still 60% of that premium, but I remove the upside cap. Because if that stock runs, I now have positive deltas up here. So here's our shares of stock. There's the covered call, but watch what happens if we sell the spread. I do this. I come right up in between them. Notice I'm $2 worse off in my hedge. I used to have a $5 downside hedge. Now it's $3. I'm $2 less on my maximum gain, but I still have $8. That's nothing to sneeze at. And yes, I had to give up all of this with the covered call, but now I get this as gains. So, that's a big difference. And in some cases, and especially for volatile markets, you have to say, hey, I'm getting $8, but I have unlimited upside. And I still have a pretty good downside hedge. Not a bad deal for those of you who are on the fence saying, should I either write the call or not write the call? This is a wonderful solution to work in the middle. Avoid the extremes. So here we've retained 60% of the premium, but now we've got unlimited gains. Again, not a bad deal. So there's the graph by itself, looks just like a combo, but we did it synthetically. Now, For some more insights, what would happen if we sold 2 spreads instead of 1? The example I just showed you was buying 100 shares and selling 1 spread. What would happen if we sold 2? Well, if you go back to that graph and think, well, we had 0 deltas out in the wings, it really shouldn't change anything out here. I should still have go slightly negative. And there we go. They're selling 2 of the 100, 105 verticals. They're selling 3. Kind of some interesting things we can do. So notice that we have a little better returns if I sell 3 if the stock falls, but I've got less profit if it rises. So depending on what's happening with skews and what's going on in the markets, we might take a lean a little bit to one direction or another. But part of my point is that verticals can be incredibly powerful tools, not just by strategies in and of themselves, but for hedging tools. And in fact, we're going to use this exact example tomorrow when we look at how you can hedge a straddle. That's something you really have to know if you are trading straddles in volatile markets like this. And we can hedge them by buying and selling vertical spreads, something that most traders would never consider. So it all comes down to risk management. Remember to manage the risk. Don't let the risk manage you. And yet that's what happens when people become fearful of volatile markets. They go to the extremes. You want to learn to work towards the middle, and selling vertical spreads against your calls or against your long shares of stock can be a wonderful way to hedge that risk. So if you like ideas like this, please, wonderful offer here. Absolutely free, 30-minute one-on-one consultation with one of our world-class coaches. We've got some amazing coaches, and they are glad to sit down with you for 30 minutes and talk about strategies that are relevant to you. What are you trying to do? And just listen to some of the tips and techniques that they can share with you that can absolutely make you better traders. So if that's something that's of interest to you, absolutely free. Phone number is 815-957-9125. So I hope that tip helped you. And again, we're going to look at a related use of that tomorrow on a hedging strategy, on hedging straddles. And I hope to see you then, 4 p.m. Eastern Time.